Unless you've been living under a rock, you've probably noticed the US stock market has been crashing, both recently and really for the whole of 2025. Or even really since Donaldinho came in November last year. In this video, we're going to look at stock market crash stats from history to see how bad this crash might be, why it might be a good thing for you, and also importantly, what you should do. Of course, even though the US stock market is crashing quite badly, this impacts global stock markets. A lot of global index funds and ETFs are dominated by US stocks. So as a result, the FTSE All World is down quite heavily recently, and it's down across the whole of 2025. And even my favorite fund, the FTSE Global All Cap, is taking a bit of a battering. Why has this happened? You already know, Trump's tariffs. These trade wars are bringing uncertainty to the markets. The markets don't like uncertainty, and as a result, the stock market has been in free fall really for the last week or two. It is worth pointing out that a crash is 20% or more. So we're not at a crash yet, but it has been very volatile, as you can see from this here. And this really doesn't happen very often. So if you are nervous or worried, it's completely understandable, particularly if you've only started investing recently. So particularly for you, carry on watching because this video will hopefully put you at ease a bit. Importantly, it's often during these pivotal moments that some big mistakes are made. What is the big mistake? Panic selling. I have no idea what's going to happen in the short term. No one knows, no bank, no economist, no one online. But over the long term, do I know what's going to happen? Also no, but I do believe the market is going to bounce back and continue to go up like it always has. The stock market has recovered 100% of the time from every single previous crash in history. And often the biggest mistake people make is panic selling because of the fear, locking in losses, selling at the wrong time, trying to time the market, and then miss the gains when the market bounces back. So I really want you to avoid that. If in doubt, zoom out is a very popular term to use when it comes to investing. And I'm a fan of it. If we look at the US stock market recently, of course, it's not looking good. Zoom out over 5 years, it looks a little bit better. And the exact same with the global stock market. The FTSE All World is looking a little bit ropey in the very short term, but over the longer term, it starts to look a little bit healthier. Returns have been really good in the US and global stock markets in the last 5 years. For me personally, I've been investing for nearly 8 years, and whilst there has been volatility, a big COVID crash in 2020, record high inflation and interest rates in 2021, 2022, the returns really have been quite good from the stock market over the last 5-8 years. And it can be easy to forget that big corrections and crashes do happen. And importantly, as investors, we need to be able to deal with them. If we want to grow and build our wealth over the decades, we're going to experience numerous crashes and dozens of corrections and a lot of uncertainty, volatility, and everything that comes with investing. That unfortunately is just part of the reality of investing and trying to build our wealth. James Shack shared a recent video on a stock market crash, and I was a fan of this screenshot that he shared where you can see that these crashes, this volatility is actually quite common. In the S&P 500, a 5% fall happens almost every single year. Even a 10% fall, what we're going through right now, happens pretty regularly, most of the time over 50%. When we start getting into 20% falls or more, they are rarer, but once again, unfortunately, they do happen, and that's just part of the reality of investing. The key point I've said already is that the market has bounced back from every single one of these falls. Another thing to point out, and I'm guilty of this myself, I will regularly say that over the long term, through investing, we can expect to get about 7% return per year after inflation, because that is what the stock market has historically given. However, and another very handy graphic that I'm a fan of from James's video is you can see here that in any given year, there can still be massive drawdowns and a lot of volatility. This looks at the Russell 3000, so 3,000 US companies, which is more, of course, than the S&P 500, which is the largest 500 US companies. But you can see that in some years where the stock market has ended very well and up in the green by quite a lot, there was actually a massive drawdown or correction or crash in that same year. But once again, the key thing to point out is you can see that there's a lot more green and a lot more years where the stock market ends up over the long term. There is always something mad going on, and this graph on the screen helps to illustrate it. There's always a reason to sell. Even in my relatively short 8-year investing career, there's almost every month and certainly every year some big dramatic event why you might be scared to invest and why you might want to sell. This current crash, it could get a lot worse. The market could keep falling, or it could get better and bounce back and all of a sudden it's an amazing year. Who knows? I certainly don't. But I do know with investing that optimists usually win. Pessimists sound smart, Optimists win, as they say, and that's especially true when it comes to investing in the stock market. Why is that? For three key reasons. Number one, the stock market goes up most of the time in any given year. Looking at the FTSE All World VWRP, it has ended up in 17 of the last 21 years. That's 81% of the time. And if you go back through history, you'll find about 3/4 of the time roughly that the stock market ends high at the end of the year than it started. Number two, because the best gains normally come straight after a crash, which is why staying invested and not panic selling is so key. There is some data on the screen and you can see different crashes have different severities and different lengths, but the best gains usually come out of nowhere when you're least expecting it, and they come pretty quickly, which is why staying invested is so important. How quickly the market bounces back depends on the severity of the crash and no one knows, but by carrying on investing and staying invested, when the market eventually does bounce back, you'll reap all the rewards being the gains that the stock market brings. This is another stat I saw recently on Instagram and once again explains that the situation we're in is pretty mental, but also usually the best gains come from these massive periods of uncertainty, which once again is why it's so key to stay invested, keep investing and hold for the long term. Finally, it's just very difficult, if not impossible, to time the market. Tony Robbins has some stats on this, but by trying to time the market, you have to get it right twice. You have to sell at the right point, ideally the high, and buy back in at the right point, ideally the low. Doing one of those is pretty much impossible. Doing both of those is definitely impossible in my opinion, and the market time and stats show that just how difficult it is. And as we already mentioned, no one knows how severe the crash will be and when the market will bounce back. So by staying invested and by carrying on investing every single month automatically, you're essentially going to be fine, because whenever the market does bounce back, if it's in 1 month or 2 years, you're still invested, you'd have still been investing, and you can once again take part in those gains when the market does bounce back, because the market has bounced back 100% of the time before. When you look at the charts, it seems really obvious. Like, look at the COVID massive drop. You just think, oh, you know, I would have sold at the peak in February 2020 and then it dropped 30 odd percent and then buy back in at the low. But in reality, when you're forward looking, it's just impossible to know. Look at the chart right now of the S&P 500 or the FTSE All World. Is it going to carry on falling? Is it going to go up? Literally no one knows. In hindsight, it seems so obvious, but when you're in reality forward looking, no one knows, which is just why timing the market is so difficult. Before we get on to what I'm doing and what you should do, it is obviously worth pointing out that these crashes and falls are painful in reality. It's not nice losing money. Whether you're a newer investor, you've finally taken the plunge and all of a sudden you've lost 20 quid, or you've been investing for decades and you've lost thousands of pounds, it's never nice. But it is worth pointing out that all of these losses are only on the paper. You don't actually lose any money until you lock in the loss and sell. And of course, hopefully through watching this video, you've realized not to panic sell. One way to think about it is that everything is actually on sale. Imagine if you go food shopping and you could get 20% off your food shop. You'd be absolutely buzzing. With the stock market, when that happens, often people are nervous. They might have invested if the market was 10% up, but when the market is 10% off, they don't want to invest anymore, but they're actually getting more for their money, so they can then make more gains over the long term. It's a massive money psychology thing, particularly when it comes to investing. But if you can try and get in this mindset where the market goes up, that's great, I've made money on paper, or the market goes down, that's equally great, I can invest at lower and lower prices, then you sort of see the stock market just as a win-win no matter what happens in the short term. Another thing to point out, if you have an emergency fund and you don't need this money for the long term, then why are you worried? If an emergency happens, you've got the cash to cover you, and you don't need this money for decades to come, then you can literally buy at lower and lower prices and hopefully make even more gains over the long term, over the decades. Of course, this would be concerning for people living off of their pots. That is why you generally de-risk as you get closer to retirement. But for people like me who are in their 20s, maybe even 30s or 40s, who are trying to build their wealth over the decades, then realistically, you don't need to worry. I know that's definitely easier said than done though. Counterintuitively, as I've alluded to a couple of times, this is a good thing for long-term investors like us, because we can buy at lower prices and hopefully make more gains over the long term. So what am I doing? I'm doing two things. Sort of doing nothing really. I'm not making any jerk movements, of course. But number one, I'm continuing to hold all of my investments. Most of my money is in global index funds and ETFs, and I'm continuing to hold them and not panic selling. And number two, I'm continuing to invest automatically every single month into those global index funds and ETFs. The benefit now is I can invest at lower prices and buy more units with that same amount of money I'm investing. So although I'm poorer on paper as I've lost 5 figures of my stock market portfolio, it peaked at about £153,000 at the start of the year. The last time I checked, it was down to £139,000. So I've lost quite a bit of money on paper. Some of my wealth has evaporated, but I'm happy that I can buy the same funds I was already buying at a lower price, accumulate more units of those funds to then hopefully make even more gains over the long term when the market inevitably bounces back. So what should you be doing? 5 things that I also recently shared in an Instagram post. So if you're not following me on Instagram, Making Money Simple for daily investing content. Number 1, as I've said many times, don't panic sell. Number 2, very important when it comes to investing, ignore the noise. I've got a guy that follows me on Instagram called Barry, and he's told me this a few times, but he gets paper statements for his investments. So he actually has no idea how much he's made or lost, which is just ideal for stock market investors. One benefit of property is you never know what the house value is worth unless you get it valued, so you can't panic sell. So with the stock market, if you can ignore the noise in this way and don't panic sell, you have much more higher chances of success. Number 3, stick to your long-term plan. For me, that's just investing monthly into global funds and holding for the long term. Number 4, automate your monthly investments. Because if you automate it, you're less likely to not invest because the market falls, even though when the market falls is the best time to invest. And tagged onto that, try and check your portfolio less often. It is difficult when everyone's talking about it. I'm even making a video on it now, and I'll check my own portfolio. But the less frequently you can check it, and that's why automation helps, the better. Fifthly and finally, now is a good time to review your portfolio and make sure your asset allocation is in line with your risk tolerance. As I mentioned already, the returns have been very good recently. If this drop has shocked you and made you essentially not be able to sleep at night, it might be better to change your asset allocation between stocks, bonds, and cash. If you're a bit older and you're still 100% in stocks, and this crash has really negatively impacted you, then perhaps it could be time to review the asset allocation and maybe allocate some money to bonds and cash instead of being 100% stocks, as one example. And that wraps up this one. I hope it was helpful to provide you some historical stats to give you some comfort. The overarching message, don't panic sell. The market has bounced back 100% of the time. I believe it will again. And being an optimist really does help when it comes to long-term investing. Good luck with your investments. Any questions, let me know. Leave them in the comments below, and thanks for watching.